Welcome to Purdue Commercial AgCast, Purdue University Center for Commercial Agriculture's podcast featuring farm management news and information. I'm your host, Michael Langemeier, Director of Purdue Center for Commercial Agriculture. And joining me today is Todd Kuethe, Professor and Schrader Endowed Chair in Farmland and Economics. Today's podcast is going to focus on farmland values, primarily coming from the 2025 Purdue Farmland and Cash Rent Survey. We're also going to stick our neck out here a little bit and talk about factors that are important looking at land values, that are coming up in the next year or so. And so we'll also talk a little bit about fundamental factors impacting land values for 26, and then talk a little bit about some projections for the rest of 25, maybe talk a little bit about where things might be heading in 26. And so that's what we want to do in today's podcast. And we want to start with looking at some U.S. farmland values. And so back up here a little bit. We'll start with some U.S. farmland values, and then we'll get into what's going on in Indiana. And Todd, really the trend is similar. The numbers are obviously different, but the trend is similar. We're going to start by talking about the strength of the farm sector balance sheet.
Yeah, so this is where I kind of always start when I talk to groups about farmland, right? Which is in part to justify why I spend so much time studying farmland and that it's such an important part of the U.S. farm economy. According to the USDA balance sheet, a forecast as of February, I know they've got a new one coming out soon, over $4 trillion of assets in the ag sector, 3.6 trillion of that is in real estate, right? So we're looking at real estate making up about 83% of the asset base, which has been increasing over the last 15 to 25 years, but it usually hangs around that 75 to 80. What that basically means, in the simplest terms, is for every dollar of stuff that farms own to produce their commodities, 83 cents of every dollar is dedicated to land. And then land has also been inching up in terms of the share of total debt. So if we look at total farm sector debt, we're now right at about 2/3 of debt is being used to purchase and invest in land. And so farmers, even though we've had very high prices over the last 10 to 15 years, a lot of people would argue, farmers have been reinvesting in sort of acquiring mortgages and purchasing land. And that's a big part of what keeps our debt to asset ratio relatively low and stable as a sector of the economy. I had a graduate student that years ago looked at debt to asset ratios across different sectors of the economy, and the agricultural sector kind of hung right in the middle. If you look at large corporations, they're running much higher debt levels. And then there's some very low debt, and we kind of hang in that middle.
Yeah, one of the things that's so important about looking at the balance sheet for a farm, and lenders do this all the time, they obviously require a balance sheet of their customers in addition to many times a cash flow projections or some historical net farm income information, is when you look at financial stress, it's both low net returns and the strength of the balance sheet. And one of the things that's really helping reduce financial stress in these times of low net crop returns is the fact that the balance sheet remains relatively strong. Like you indicated, the debt to asset for the U.S. farm sector is only about 13%. But even on the larger farms, if you look at the FinBin data out of University of Minnesota, the debt to asset ratio is still only 30%. That would be quite a bit lower than a lot of corporations in other industries.
And a lot lower than a lot of smaller businesses, right?
Yes.
Like they're sort of equal size in terms of economic activity or employees. The farm sector is very stable that way.
Let's talk a little bit about the trend in land values going back to all the way to 1950. So it certainly looks like it's been an upward trend.
Yeah, I put 1950 back in here, and I always toy with how far back to go. In fact, the U.S. federal government has collected farmland price information since before the USDA was created, right? Because agriculture is such a big part of the economy back then. But I cut off to 1950 here in part to show the one thing I always feel like I have to show is the 80s.
Yeah.
Part of it, I was born in 1981, and so I've had a lot of audiences continually to this day. People will say like, well, you weren't around in the 80s. You don't really understand what it was like, right? Where we had that period of increasing our international customer base, increasing productivity, a lot of use of technology. So we had that rise in the late 70s of income. And then we had things like inflation and falling apart trading partners and vast other things that sort of led to that decline across the economy, but it was particularly hard hit here in the ag sector, right? And so that 80s, which was a astronomical rise and fall, that 70s, 80s period, now as we start to collect more time, starts to look more like a little bump.
Yeah.
right? And that's because we had sort of a rebuilding period in the 1990s, and then sort of post RFS, I think is where we can start to really see the break in terms of aggregate land values in the country shooting up. And this year, the USDA report that just came out in August puts national at $4,350 an acre. One of the things I always have to point out is a couple pieces of information related to this. One is the USDA, the base source of information is what they call the June Area Survey, which I believe used to be called the June Agricultural Survey. And that's predominantly to track production, but they also ask about land values and cash rents. And so they're surveying thousands and thousands of farmers. These are farmer reported. And then statisticians sort of across the USDA are making adjustments and considering that data to produce sort of state level and national estimates. And so that national, this is all of the US. So it moves very slowly. Even at that, you can see we've had a really strong uptick, particularly since 2020. Uptick like we observed sort of in that 2005, 2010 period.
Yeah, what's truly remarkable on this graph and other graphs looking at land values is the sharp increase since 2007. I mean, the difference that ethanol made in terms of prices is well documented, but it's also well documented that the increase in prices just shot up after that. And even in the U.S. numbers here, it more than doubled. The land values more than doubled since 2007. The increase has probably been 2.5 to 3 times in some of the Corn Belt states in terms of land values. And so obviously that was a very important time period for agriculture and continues today. I mean, we use 35 to 40% of our corn crop for the ethanol industry. And so that's truly remarkable. I want you to comment a little bit on the difference in cash rents from the USDA survey versus the Indiana, Purdue survey or Iowa survey or Illinois survey, because they are different. I mean, typically the USDA numbers are lower than the numbers coming from the state surveys.
Well, so one of the things is, again, all the USDA surveys are coming from farmers, right? So like the survey that we do here at Purdue, we're surveying people that interact with the land market as part of their general profession, but it's usually people like farm managers, appraisers, brokers, lenders. And so they interact with a lot more with sort of professionally managed land, for lack of a better term. The USDA also, when they survey a farm, they just ask about the sort of average cash rent on the land that they operate. And as you know, here in the Corn Belt, particularly commercial farms where they're supporting a household with farm income, they're dealing with multiple landlords, right? And so there's a huge variation.
I think
even within a farm, what they're paying for different parcels.
I think that key word there is USDA is more average,
yes,
whereas the state numbers are really marginal, if you will. They're on the edge. This is if a tract came up to rent, this is what we would expect to rent that tract for. Not what the average is for all the farms in the area, but this is what that tract would rent for. And those are two different numbers if you stop to think about it. So that's really good. And I think I wanted to ask you that question. The USDA probably does not separate out arm's length. Do they separate out arm's length transactions from non-arm's length?
It's been a while since I've read the survey documentation. But no, they just ask what is sort of the average cash rent you are paying.
So you've got some rental rates there that might be with people relatives that might be quite low.
And again, I think one of the reasons that the USDA moves so slowly is that for everybody that's getting a sweetheart deal from a relative and paying low rent, there's also somebody overpaying the rent.
Yes.
Because they're trying to get some money to their parents that won't pay for the nursing home without, so you overpay the rent to give them the cash. There's all these sort of things when you start looking into the details. The analogy I often use with the USDA numbers is that it's like a glacier. Like it's moving in the right direction, and a glacier will change speed and change direction, but it takes a huge force or just a sustained force to do so, right? So this is kind of that glacial trend of what's generally happening in the land market. The other thing I wanted to point out, Michael, here, since you asked about the differences, it's also sort of what we're capturing the value of. So on our survey, for example, we ask about cropland, and I know that the Federal Reserve surveys, they'll say bare farmland, but here the USDA uses the term farm real estate because that is buildings as well as structures and improvements. So if you have things like tile drainage or hog barns or whatever, that should be all captured in this sort of real estate.
I mean, there's quite a few things that could be captured in that value.
It does omit the operator's dwelling, I believe.
Yeah.
But anything that's sort of a building and improvement related to farm production is in there.
Now let's talk a little bit about the trends in Illinois, Indiana, and Iowa compared to the U.S. And I always find this rather fascinating.
So, a couple things. One that I always point out is that gold line from the previous with the national. When you start looking at the sort of the I states, it looks virtually flat. And if we go back farther, like pre 1950, the U.S. and the Corn Belt area sort of moved the same. They didn't move much. But really starting in the early 70s to mid 70s is when you really start to see a gap between Illinois, Iowa, Indiana, and the U.S. in aggregate. And then among those three states, the I states, Iowa seems to be the most dynamic. It has the steepest inclines and declines. And then Indiana, at least over sort of the last kind of 15 to 20 years, has been sort of the most stable. And in a lot of years, sort of the lowest, even though it used to kind of hang in the middle between Illinois and Iowa. And then also, because I used to work at the University of Illinois, I started putting this together because the farmers would, like, there was a rivalry between Iowa and Illinois. Anytime I would say, like, the Iowa numbers went down, the crowd would cheer. And you can't not have something the crowd would cheer for.
I was in Illinois yesterday, and I told the audience that Iowa adjusts more, and then Indiana is the least of the three, and then Illinois is in between. And I think that's what the chart essentially is saying. The reason why this is important is this is a land value chart, but Iowa has seen a little bit more weakness in cash rents this year, and maybe that's hearkening to what we might see in a year or two, because they typically move fast.
I've heard a number of people say that what happens in Indiana happened in Iowa last year, right? That seems to be it.
So that's why we kind of look at those, look at all three of those. And then I want to talk a little bit about a slide from the Ag Economy Barometer. Again, this is the July survey. We do this every month. But here's how it's worded. Compared to today, what are your expectations for farmland prices in your area 12 months from now? And so we just say farmland. This could be pasture, this could be cropland. But this kind of gives us a gauge from the U.S. perspective on what's happening to prices. And in the July survey, 29% thought land prices were going to increase in the next 12 months, 14% lower. That's been fairly consistent here since the first of the year. And so what that tells me here that there's still more optimism than pessimism in U.S. farmland.
The way I always think about it is I take the optimist and I subtract the
that's pessimist, a good way to do
right?
it.
And so we're at like a positive 15, which means there's like, a bit of optimism or upward pressure. I don't know if everybody's optimistic about prices going up, but they believe prices will go up a little bit. If compare that, particularly when we think about like coming out of COVID in like 2021, where we had very few people expecting lower prices and the bulk of people saying higher, right?
Yeah, definitely. When we were in that double digit increase in prices, we had 50, 60, 65% of the people thinking that prices are going to be higher. Now we come down to earth a little bit. It's a 29%.
Well, in that missing group, right, that other sort of little over half are thinking
remain
stable,
the same,
right?
And
they're kind of thinking stable.
Yeah, and that's about 50% right now. And that's kind of consistent with our expectations, which we'll get into here. Now let's turn to the Purdue Farmland Value and Cash Rent Survey, focusing on the land values. And so give us a little history of this survey and what numbers are reported in the report that's on the Center for Commercial Agriculture website.
Yeah, so this survey has been around since the mid-1970s. Our department has done this annually. And it was initially created because there was very little information about land markets around Indiana, right? So it was created by some faculty here and working with stakeholders around the state. And a lot of our respondents are still people of similar professions. I don't know how many of them are still working since the mid-70s, but they're generally people that interact with the land market as part of their regular professional life. And so we're looking at a lot of rural appraisers, farm managers, brokers, ag lenders, and a few farmers in there as well. But it's generally people that are sort of in the land market professionally. And we do ask about both land values and cash rents, but really what we're looking for our primary respondents is people that can speak or give information about the land prices. And so we collect 3 different prices. So this survey goes out in June. So we always ask about the current June, but then we also ask about the previous December, where it was to end the last year, in part because we're also wanting to know what do they think is going on for the rest of the year? Where do they see it this coming or projection for the end of this 2025? And so we ask the respondents about average land prices that they're seeing in their county that they operate or work in. And then we aggregate that up to 6 regions across the state and at the state level. And we ask them about the land prices for 3 quality grades, top, average, and poor. And we don't define those. We just ask them, and then we also ask them to report their long-run corn yield expectation for top, average, and poor quality land in that county. So that allows us to translate things, prices as bushels yielded, and can help control for those quality differences. Right? So top quality land in the southern part of the state is very different than what we think of top quality land in the northern part of the state.
So let's get into some of the numbers. Before we get into the land values, I've just got a couple slides on cash rents. We've covered this in another podcast, but just briefly talk a little bit about what cash rents did in 2025, Todd.
Yeah, so these two numbers, at least according to economic theory, should be linked,
Yes.
right? We should expect sort of an equilibrium relationship there. And we've seen cash rents increase by 1.5% to 2% at the statewide average over the last year. And that's similar to what we've seen the last couple of years. So they're ticking up gradually.
And even though these two numbers are linked, we're going to talk about some factors that impact land values. That's one of extremely beneficial pieces of information in the survey report, as we talk about 11 different factors and how they might impact land values. When we talk about cash rents, the main factor is net return to land. And so that's the main factor. When you talk about land, it's more complicated than that. There's a lot of other things that impact land values. And so even though these are two linked, they can move in different directions, and they certainly can increase or decrease in different magnitudes because land values does have all these other factors. So keep that in mind when you're looking at the report. Let's get into the 2025 state averages by land quality.
Yeah, so if we look at the survey results across the state of Indiana, we've seen sort of middle level increases. So thinking about like 2020, 2021, where we had like a real uptick. We're not there, but they're not exactly flat. They're moving up a little bit higher than the rate of inflation. But we've seen sort of 3 to 7 or 8% increase across the state. For top quality land, we're now looking at almost $15,000 an acre, $14,826. For average, we're at $12,250. And then at the poor quality land, we're looking at about $9,761, I guess is what we have here. So about almost $10,000 per acre.
I don't want to read too much into this, but I was a little surprised at the large increase in poor quality ground, because if there's any ground that where the net return to land is probably not very good in 25, it's this poor quality land. Do you have any thoughts on that, Todd, for why that might have been a little higher than the other two?
Okay, so a couple things. One that's sort of like evergreen belief, which is that poor quality land is like the hardest to derive a value from. You see the most dispersion, right? Because some people are buying it for recreational purposes, or, they are going to grow crops on it, but they mostly want to deer hunt or something, right? And we see sort of smaller plots and sort of like, people other than just farmers buying them. And those will sort of like come and go. The other thing poor quality land is sometimes used for is livestock, right? So we have higher livestock returns. It could be some of this poor quality land is on that margin between, do we use it for pasture or do we use it for
even hay
or silage? Or hay.
Even hay, something like that. Now that average at 5.5%, that's not too different than the historical average return on land.
Yeah, that's about what we sort of see kind of over the last 25 years.
You kind of put that in perspective. And we are talking about the fact that the report that has the cash rents and land values is in the August PAR report. In that PAR report, there's also an article looking at investment returns for land and other assets. And so take a look at that, see how land compared it to some other assets.
Yeah, I had an outstanding graduate student work with me on this, and that it's a thing that comes up all the time because farmers are so heavily invested in land, like we said at the top of the podcast, right? That they want to know, well, what would my money be like or returns be like if I put it in something else? And so once again, we find land sort of sits in the middle of all of our investment opportunities, and that it offers a higher return than just buying bonds, right? The safest investments, but not as much risk exposure as we see in like equities.
Yeah, certainly when you compare farmland to the S&P 500, the S&P 500 is considerably more risky. And so you wouldn't expect to get the same rate of return long term as you would with the S&P 500, because there are differences in risk. And so that article talks a little bit about differences in risk too. I just wanted to make a note that there are regional farmland values in the report. We're not going to dwell on those other than saying that there was some different trends between the North and the South this year. And that's not that unusual, but it was rather obvious this year. And so if you could just talk a little bit about that.
Yeah, so there's a couple things. The Southwest and Southeast regions had a decline in land values relative to the year before, where all of the other northern 2/3 had an increase of varying degrees by different parts of the state. If you remember over the last couple of years, the Southwest and Southeast regions have been growing the fastest, right? So again, sort of like when we were talking about comparing Iowa and Illinois, we also tend to see places that are increasing the most are often the sort of first to decline.
Yeah.
That's sort of generally true of the economy. And then also, I think all of the factors that we think about when we talk about what drives the land market, those are different in the southern part of the state than the north, right? So you're looking at different commodity mix. You're looking at different land use or development potential.
Yeah. So there's a lot, we're going to talk about the factors here, but the factors would vary by region. Let's take a look at kind of historical trends since the late 1970s in top average and poor quality land in Indiana.
Yeah, so the survey was started again to provide land information for Indiana stakeholders. And then the report was able to survive, even though the first thing that happened was we see that early 80s land price decline, right? And then it was relatively stable from kind of the late 80s through 2007, 2008, just like we talked about at the national level, right? And then we have this sort of post-RFS commodity price boom, and we see prices really shoot up quite a bit. And then sort of 2013 to 2019, prices moderated or held a little bit stable. And then the most important thing happened. I took over the survey, and prices just shot up. No, it's COVID, right? So the sort of post-COVID period is when we see another sort of dramatic increase. Again, not as much as we did see that 2021 increase, but we still have seen that sort of continued increase over the last few years.
And just to put this in perspective, since 2007, you look at average quality land, it's close to a tripling. Don't necessarily expect that to happen for the next 25 years, but certainly since 2007, we've had extremely strong rates of return for both poor average and top quality land in Indiana. Now, let's talk a little bit about the land value factors. There's 11 of these. 10 of these have been in the survey for a long time, and you added the conversion recently. And so talk a little bit about which one of these are negative and which one of these are positive in terms of explaining land values.
Yeah, so this is my favorite part of the survey. This is the part that I enjoy the most. Well, this in the comments when I get some, because some of the comments are pretty fun. So we ask all of the respondents about these things that we generally associate with moving land prices. And we say, is this a positive force? Is it pushing land prices up, or a negative force in your area? And we have them rated on a scale of 5, positive 5 being a strong positive force, negative 5 being a strong negative force, 0 then, of course, being neutral, doesn't really matter. Right? And so we look at the average of those scores. So when the value is greater than 0, then we say on aggregate, it seems like this is putting upward pressure. And when it's less than 0, then it's negative pressure. And we can sort of compare across those different categories, but we can also look at how that's changed over time. So the graph that I have in the report, I always show sort of the last 3 years. So if we look at what is putting downward pressure, we're seeing an increased downward pressure relative to last year for net income. A lot of that, I think, is the downward pressure we're seeing in crop prices. In fact, the livestock price is actually one of the things putting upward pressure, but crop price putting downward pressure. Interest rates, again, is still negative, as it has been the last several years, but it does show a much more muted effect. I think people have kind of gotten used to the interest rates that we have, or maybe they're thinking, oh, rates will come down a little bit, and so it's not quite as much of a driver. There's also a little bit of downward pressure from the return to alternative investments, so maybe investors are looking other places, and then exports of ag commodities. We ask about inflation. It's putting a little bit of upward pressure, but again, not very strong. Same thing with farmers' liquidity. How much cash do farmers have on reserve to buy land or invest in their farms? Positive pressure, but again, way lower than it was a few years ago. Agricultural policy, interesting enough, it's a very small number, but it is negative, which I think is sort of weird. I was kind of surprised. anytime they think that ag policy is not supporting land
I-
prices, I'm always a little bit
It's
curious.
probably asked fairly generically. Does it just
Yes.
say ag policy?
Agricultural
I
policy.
don't want to read too much into that, but I think when I think ag policy, I think safety net. And
Yes.
the safety net actually was strengthened with the legislation that came out this summer. Some of these might have answered the survey before that, but I think also when they talk about ag policy, they probably were thinking about tariffs.
Yeah,
Certainly the negative.
It could be. It could be tariffs. It could be tax policy.
Yeah,
it could be anything.
It could be a
like
lot of
there's so
different
much
things.
stuff that's
Yeah,
policy.
so- But that typically isn't a real large bar. I mean, when you took a look at the large bars in the last several years, obviously net income it was hugely positive in 23. Now it's quite negative. That one moved a lot. Liquidity moved a lot. Like you said, it was really strong in 23. It's still positive, but it's down a little bit. And then one you haven't talked about here that I'm glad you added is conversion.
Yeah, so I added it to last year's survey, and I think I mentioned it in the report, but didn't have it in the graph. And I was waiting until I had at least 2 years so we could see how it's moving. And so we ask about land conversion. Now, I use the term conversion specifically. The survey for a long time, we've asked about land transitioning out of agricultural production, and we've asked about recreational land. But I use the term conversion because what we're seeing across the state and across the Corn Belt in general, right, is not just converting to subdivisions and golf courses. Like we see sort of traditional spread, but we're seeing a lot of like infrastructure development, or new like large civic projects, or things like conversion to energy. So energy and wind. So asking about like how much do you think conversion is what's driving? And again, it's the strongest positive force that of the factors people have identified.
Yeah. And I think when you combine all these factors, I think it explains why the land prices went up a little bit, but nothing like they did a couple years.
Yeah. If you look back, I mean, all the way back to, I think it was 2020, 2021, everything that could impact land prices was pushing it up. And we did see record growth.
Yeah.
Right. And so, yeah, you're right. I look at that sort of how tall are these bars, but also how many are pointing up, how many are pointing down.
Let's take a look at the projections. You have a June 25 number, and then you have a December 25 number. What did they come up with in terms of the projected increases in land values in the next 6 months?
So they're actually, I would say, modestly optimistic. Expect to see some growth, particularly for the poor and average quality land. I would say sort of guarded optimism. They think prices will come up, but not like it's going to be gangbusters. But I was also sort of relieved that they weren't predicting declines. Often it seems like if you go back to the old reports, they actually tend to expect declines. A little more pessimistic audience.
Yeah, they're higher than inflation.
Yes.
And so I think that's very important to point out. And I think they're very consistent with, again, this historical averages that we've seen over a long period of time, that 5 to 5.5%. Very consistent with that. Now, a couple of the things that are in the report here that would be of interest to people in areas that are transitioning out of agriculture, i.e., around Indy and other large cities like that. You've got some questions related to transition values per acre, and you call this a development premium. So talk a little bit about what that is in 25 and how that's changed. It looks to me like this has changed a little bit in the last few years.
Yeah, so we asked specifically about the price paid per acre for land transitioning out of agriculture into some other use, right? We do tend to think about that in terms of like suburban development kind of things, but it's not limited to that. Post 2020, we saw an explosion in the value of transitional land and a real demand for people. There was all the news stories around COVID of like people wanting to move out of the country, get away from congested areas or whatever, right? And then this year, we actually saw a little bit of a decline in what we're seeing, that transitional value. But I often look at I call it the development premium because I look at how does that transitional land compare to top quality land. And as a rule of thumb over the last, 15, 20 years, any farmer will sort of sell their land for twice the price, right? Or twice the value they get for agriculture. And so that's sort of the premium I kind of look at. What is that gap between the transition and average? And if you flip forward for those viewing, this actually tracks really well with construction permits, right? So this is Indiana state level information on housing permit. If you look in the 1990s, we had very high development premiums and we had a lot of construction. And then it really slowed kind of around that housing crisis. And actually in Indiana, it hit here a little first, that we had a slowdown. And then it's been sort of gradually rebuilding. That development premium basically follows that lockstep. As the construction slows down, there's a lot less conversion of farmland. And then as that starts to tick back up, we start to tick up. In the last year, they've both come down a little, but the overall trend of the last 10 years is gradually up.
Now, we always have a caution about using values directly out of the report. There's a lot of variability in farmland values. There's particularly a lot of variability in transition values. And so just to note that, I mean, when you have an average around $27,000, $28,000, I mean, there's obviously tracts that are going to double that. So there's a lot of noise there. We're not trying to pick up all of that variability. We're just trying to pick up what does that look like compared to average and top farmland.
Yeah, because I mean, transitional land is almost like snowflakes,
Yeah.
where they're like each is sort of unique.
Yeah.
And every time I present this somewhere, somebody's like, well, do you know about this one
Yes.
here that this what like, and I'm like, I don't know about that specific one probably, right? But generally this is kind of the momentum or the trend that we're seeing. Yeah.
So let's summarize the information in the report, and then we'll kind of switch gears here a little bit and talk about some more about factors impacting land values.
So I sort of put it here at the end because I feel like when you're writing a land value report, you can almost every year title it new record high.
Yeah.
It tends to trend up. We do say it again at the state level, but the difference is what we're seeing is more of a diversion compared to the last several years between the southern third of the state and the northern 2/3, where we saw a dip in decline in land values. And depending on the quality grade, we're looking sort of across a big area. I'm sure there are local markets that had even more extreme declines or even some increases, right? But generally that bottom third of the state has been declining, and we see an increase across the other 2/3 of the state. The key drivers impacting the market this summer, and I think we'll have to continue to think about them going into next year, are lower returns, lower incomes, lower crop prices, and how that's putting downward pressure. And again, on the upward pressure, a lot of it's still land conversion. How much continued development are we going to see going into the next couple of years? And generally, the respondents are optimistic about prices. I should say they're expecting prices to increase through the remainder of the year, which is not rare, but not the most common, right? We have sort of seems like people are always pessimistic about the land market, but not this year.
Now, for those of you that want to dig a little deeper, we're going to talk about some of the key factors impacting farmland values. And so we're going to go over this relatively fast, but there are slides related to those. Again, for those that want to really think about what impacts farmland values. And when we talk about fundamentals, what are we talking about in terms of fundamentals? And Todd, so let's just ask you the question. When we think about a simple model of farmland prices, what are the fundamentals that we think about?
So I usually, when I present this to an audience, I put a little break in here because I tell them there's going to be some math on the next slide. And so we may have just lost most of our audience here, but it's what we learn in economics, finance 101, net present value, right? So the value of any asset that we own is based on how much we think we can earn by having it, right? So we think about the price of farmland. Generally, as a rule of thumb, we look at all of the ways we could make money from farmland. So we could cash rent it out, we could farm it ourselves, we could develop it into something else, right? Those expected returns, and then we discount those. So we divide them by some discount rate, and that's because we want money now, not in the future, right? So we're worried the future might not happen, right? And so anything that you're going to pay me next year, I'm not going to put as much confidence in that as what you'll pay me this year. And I think if you think about just those two factors, that's what describes a lot of the variation that we see in land prices. But it also describes when you go to like an auction or people are talking about recent sales, a lot of what the diversion will really be like, oh, I think this could be that expected return.
I think the discount rate's different.
Or I think that expected return could grow, or if I manage this, I could get those costs down or whatever. It should be worth more. Or they discount future returns differently. And so I often use the analogy of like, it's the difference between loaning money to my wife or loaning money to my kids. So my teenage kids, I would have a much higher discount rate in terms of probability I'll actually get paid back in the future.
One of the reasons why we're talking about this is the discount rate and the growth rate, when you combine those two, is only about 2%, 2.2%, 2.1%, 2.2% in there. That's called the capitalization rate. Typically, it's really low right now. And what these slides talk about is what would happen if that capitalization rate increased. And why would that increase? Well, if interest rates stay high, there probably will be at least somewhat upward pressure on that discount rate / capitalization rate. These slides kind of look at how sensitive land prices really are to increases in discount rate and increases and decreases in expected returns. One of the things you have here also is looking at a farm income forecast. We could spend a lot of time on this slide. We're not going to, but farm income is forecast to be quite high in 2025.
One of the things that's going to drive is how much money we can expect to earn it, right? So I look at the USDA farm income forecast to give me an understanding of like, where is the ag sector at large? So if we're looking at a particular county in Indiana, it's much better to look at like prices and yields in that area.
Yeah.
But if we're looking at sort of nation as a whole, what I think is going to happen to land prices, the best source of information is USDA. And so they do a farm income forecast. So they produce an estimate, what they call their estimate, or their official measure of net farm income, which is sort of the value that the agriculture sector generates and a retained earnings, I guess, right? And this is sort of a system of national accounts. So we've got all the different kinds of agriculture. And so we'll have places where it's rising and falling, different commodities. But this is sort of what's the aggregate picture look like. A year to put out after the year ending close. So we find out in August or September how the previous year did. So to provide more timely information, they forecast it several times a year.
Yeah.
And so there's a lot of stuff in the ag media, like when it says like USDA is forecasting farm income to do this or that. So I've been for a number of years just sort of tracking how that forecast evolves. And so they're saying for 2025, now this is based on the February forecast.
Yes.
They've got a new one coming out shortly.
In early September.
Yes. So we'll see some adjustment likely. That's when we'll find out what actually happened in 2024.
Yeah.
And that September report comes out. But generally, over the last 20 years, 25 years, the aggregate number ends up actually coming in higher than the initial forecast. So they're saying they're expecting a profitable year. There's a chance, if the pattern holds, that will actually come in a little bit higher than that. Weird to say this at this current time.
But you got to remember, there's a lot of different numbers that are going into that net farm income forecast. And here we're here in a state where crop income is so critical. And two of the forecasts in terms of Indiana. You got to remember the U.S. livestock is more important, relatively more important, particularly as you get into the Great Plains. And I'm hearing that the net farm income 25 coming out in September could be higher than the February number because livestock prices are actually stronger than we thought they were going to be early in the year. And also, you go back to the revision of the safety net that happened this summer, the safety net payments are probably higher. And you combine those things with relatively low crop returns, and you're still looking at a pretty high net farm income forecast.
And historically, that sort of what I call here the August, or it'll be September this year, that number actually, in more years than not, is more optimistic than we had in February.
Yeah. And just a reminder that, obviously cash rents are very important to land values. We've talked about that before. They were up slightly in 25.
And cash rent is where I actually think of as like sort of a local measure of potential return, right? So the joke I always make is that the easiest way to make money for farmland is just rent it to somebody else, have them do the hard work. That sort of gives us kind of a baseline expectation of what we think we could earn.
Even though in the net present value model, it's expected returns, a lot of us use cash rents as the proxy for expected returns. But you could use expected returns for a specific farm in that forecast. Just be careful when you're doing that. It's expected returns, not the return you had in 25 or 21 or some kind of historical return like that. The other thing that I just wanted to note briefly is discount rates are higher right now. We do expect a little bit of softening, perhaps coming here in the next month or two when the Fed talks about interest rates again. They're up quite a bit from what they were 2-3 years ago.
Yeah, and I have, for those watching, 3 different discount rates here. Right. So the bottom is the Fed funds rate. So that's what the Fed sets for the overnight deposit rate. Right. So that's set by policy. The prime rate is generally what banks give for short run loans to their best business customers. And so that's sort of the difference between the prime and the Fed funds rate is kind of the bank's cost of doing business. And that stays relatively stable. And then the other one is the farm mortgage rate, which I got from the Federal Reserve Bank of Chicago. So that does include the northern 2/3 of Indiana, but it also has southern peninsula of Michigan, a little bit of Wisconsin, all of Iowa, and northern 2/3 of Illinois as well. So it's kind of the Corn Belt area. And I often look at sort of the difference between the farm mortgage rate and the prime rate, or the difference between farm mortgage rate and the Fed funds rate. Because I have a lot of people that will say to me like, oh, the Fed's going to do this. What's that going to do to the land market? those two things do move together, but it's not as lockstep.
Yes.
So we've seen over the last several quarters where we see farm mortgage rates coming down. We also have seen the federal funds rate coming down. When we see the federal funds rate shift up, we often see the farm mortgage, but it's not a one-to-one correspondence, right? I don't think the Fed is controlling mortgage rates. They're influencing it.
Yes.
But like bank activity in the organic market.
Part of it is the length of loan. I tend to think that the prime rate's more of a short-term rate.
Yes, that's exactly.
It's more correlated with the operating interest rate. And operating interest rates do not necessarily perfectly correlate with mortgage rates because of the different time frame.
Yep.
One's a year and one's much longer than that. And so sometimes we discount the future more, sometimes we don't. And so there could be differences in those over time. And we're kind of seeing that in this chart here for a period of time there, quite a long period of time there. The mortgage rate was quite a bit above the prime. Now it's pretty lockstep since 2020.
Well, the other one I think about, or I talk to my students about, that I always say, if you talk about the difference between operating and real estate loans, if somebody defaults on a farm mortgage, the bank owns a farm. If somebody defaults on a operating loan, then maybe they get the grain and storage or something. Which would you rather have? And we're at a case where, like right now, we would rather have the mortgage. So that's why we see the sort of the downward pressure on those rates.
Good point. Just a couple other things here to kind of wrap up. I did want to talk a little bit about rent ratios. The capitalization rate, which we've talked before, is essentially cash rent divided by land value. If you look at the regional land values, the capitalization rates from 2 to 2.5, where the state average is about, I think, 2.1, 2.2, someplace in there at the lower end of that range. But the historical average is 5. All that means is there's been some periods over the last 50, 60 years where the capitalization rate was considerably above the 2 to 2.5. So you always have to ask your question, we're going to revert back to the mean? Probably not anytime soon. That's kind of what our thought process is here. What I've done here in the P rent ratio is I've just inverted that. So rather than doing cash rent divided by farmland price, I do farmland price divided by cash rent. And this is analogous to the PE ratio that's used to look at the stock market. For example, right now, the PE ratio is around 35 for the S&P 500. And so that just gives you a frame of reference there. The historical P rent ratio is 20 because, 5% inverted is 20. But in 2025, it's 40 to 50, depending on the region of Indiana that you look at. So it is high. So the question naturally to ask here, just like if we had a high PE ratio, are we overvaluing land? Well, the short answer is we don't think so. We're overvaluing land. But I do want to have a word of caution here. If you have a relatively high P rent ratio, what does that imply about future earnings for that investment in real estate? And the way to think about this, if you have a relatively high farmland to rent ratio, that means that the farmland was relatively expensive compared to the cash rent that could be generated from that. And so you wonder, you ask yourself, could there be buyer's remorse? I paid quite a bit for this land. Maybe I paid a little too much, based on the fundamentals, cash rent being the fundamental. And so maybe my rate of return will not be real strong in some of these years where the P rent ratio was relatively high or farmland prices increased faster than cash rent, which was in recent years, that has been the case. And so I've got a chart of the historical P rent ratio, just showing the average and where we've been at since 1960, essentially from 1960 to 2004, 2005, right before RFS, we were below the 20. And then since there, we've been above the 20. And really, Todd, that's reflecting the change in interest rates. The capitalization rate's been lower in recent years compared to what it was historically. And so that's what that's illustrating. And then I look at the negative relationship between 10-year rate of return and P rent 10 ratio. And so if the P rent 10 ratio is relatively high, meaning farmland price compared to the 10-year average earnings is relatively high, that implies that perhaps the rate of return is going to be a little bit lower than it would have been if we'd have bought land at a lower P rent ratio. And so I've got a slide that illustrates that. And sure enough, if we look at the latest number in 2015, we were looking at a rate of return there of 5%, which is a little bit lower than long run of rate of return. It just implies that there is a negative relationship between these two. So if you do buy at a higher P rent 10 ratio, you do tend to have a little bit lower return. But this chart is looking at 10-year rates of return going back to 1960 that average slight negative to 20%. That seems like a large range. That's tiny compared to the stock market, okay? And so just remember that when you're looking at this chart, that yes, there is a negative relationship between these two. And if you do buy land when it's relatively expensive compared to cash rent, you would expect a slightly lower rate of return. But quite frankly, even the 25-15 number, 5% is not too bad. You add cash rent to that, and you're looking at 7.5%, 8% return for land in the last 10 years. Not too bad. I also encourage you to take a look at the relationship between the 20-year rate of return and the P-rent 10 ratio. And the reason why I really like this chart, Todd, is the first time I showed this to one of my colleagues, they said, holy cow. If you look at rates of return from 1960 up to the current period, the most recent being 2005, because we had to have 20 years of data, they range from 6 to 14%. That's not too bad. Again, compare that to the stock market. Even 6% is the worst in terms of the 20-year rate of return. And we had several years there where it was over 10%. Probably half the time, the rate of return was over 10%, and that's before the cash rent's added. And so what this clearly shows is there's a negative relationship, but also shows that land's had a pretty good rate of return since 1960. And so I encourage you to take a look at the report, look at the cash rents and land value. It looks at rates of return of farmland compared to other assets, and then take a look at these P-rent ratios and read through that. A lot of good information in that August PAR report. So thanks for joining us. Just a reminder that there is a separate podcast for cash rent, so we also encourage you to listen to that podcast.
Thank you.